Hello everyone. We've got a timely update on NIO, and there's a lot to unpack regarding their latest numbers. Last week, NIO vehicle insurance registrations plummeted to around 3K, a steep drop compared to the previous figures. This decline is notable not only because it's down from 4K, but also because it puts NIO below competitors like Xpeng, which registered about 3,600, and even Fox, a brand many anticipated would fade out, which managed to hit 2,200. The question on everyone's mind is, why is NIO performance slipping, and what can we realistically expect in the near future? Adding to this concern, NIO stock is reflecting investor uncertainty. Early trading data from both pre-market hours and the Hong Kong Stock Exchange shows NIO taking a hit, with shares initially dropping over 5% and peaking at a 7% decrease. This drop confirmed a head and shoulders pattern on the chart, often an indicator of a bearish trend, so let's discuss what this might mean moving forward. In response to this situation, NIO CEO has emphasized a strategy shift where NIO positions itself as a premium, high-margin brand focusing on luxury, while its sub-brand ONVO is intended to drive volume. However, ONVO hasn't yet ramped up its sales volume to the level needed for weekly insurance registration listings, as it's still under 2K per week. This development process will likely take more time before we see ONVO numbers appearing consistently in higher sales figures. In China, NIO has continued to push incentives to attract buyers. They recently expanded their charging and battery swapping subsidy for new customers. For those who place orders after October 11th, NIO offers up to 3K RMB, around $500 worth of free charging and swapping credits, along with additional swap vouchers. This means that if you drive conservatively, you might not need to spend any money on charging or swapping for up to a year or two. To make this incentive more attractive, NIO has increased its initial subsidy allocation from 600 million RMB to 1 billion RMB, demonstrating their commitment to support sales through these incentives. This move shouldn't immediately impact their balance sheet since costs are gradually realized each time a customer uses a charging or swapping station, typically at a nominal fee of 1 RMB, or about 15-20 cents per use. This tactic reduces short-term revenue on charging, but helps to retain customers by lowering ownership costs. In addition to this, NIO continues to offer a trade-in program, along with other subsidies available in specific cities. If customers swap an internal combustion engine vehicle for a NIO electric vehicle, they may still receive financial incentives. Some locations also provide direct subsidies for EV purchases. Taken together, these programs create a strong incentive structure for NIO buyers, making it less likely that a lack of incentives is behind NIO recent performance issues. So, if incentives aren't the problem, could it be a demand issue? Recent events suggest this might indeed be the case. NIO ET5T model received critical feedback following a test by D-Car, which gave it poor marks in certain areas. Many NIO enthusiasts and company insiders disagree with these results, seeing the test itself as flawed. In the test, D-Car performed a collision scenario where a lower-placed vehicle performed better, and comparisons were made to Tesla Model 3, rather than the Model Y, which some found odd. In the Model 3 case, it struck the tires before reaching the pillars, allegedly yielding better results due to the car's lower build. However, higher-set vehicles, including the ET5T and even luxury models like G-Wagons, did not perform as well. Furthermore, the test involved a 40% collision, which led to airbag malfunctions and door handles not deploying as intended, adding to the public concern. This type of publicity isn't helping NIO image, as it raises questions about the ET5T safety. In response, NIO has contested the validity of the D-Car test, pointing out that their cars have earned 5-star safety ratings from respected sources, and they believe the results don't accurately represent their vehicle's safety. Nevertheless, it would be misleading to say these results haven't influenced consumer demand. Potential buyers reading about these incidents might hesitate, particularly if safety is a key priority for them. The ET5T is a critical model for NIO since it is their second highest selling car, after the ES6. To have such a high-volume model under scrutiny for safety concerns is a serious challenge for NIO. Addressing this may require NIO to conduct their own crash tests in-house, under controlled conditions, to reassure customers that their cars are, indeed, safe. It might be beneficial for NIO to directly replicate the D-car test, document the results, and clarify any misconceptions. This would help to restore confidence and demonstrate that features like door handle deployment work reliably in real-world crash scenarios. Further complicating the picture, recent reports of an ET7 crash showed similar door handle issues, where they failed to deploy during the accident. This incident adds to the negative press surrounding NIO crash performance, although it's worth noting that not all test outcomes are consistent with this narrative. Hopefully, NIO will conduct further testing to address these criticisms and provide greater transparency. Looking ahead, NIO is counting on the success of ONVO to bolster overall delivery numbers. If ONVO production ramps up as planned, it could help compensate for any shortfall in NIO main line of vehicles. There's optimism that NIO might eventually reach the 20K deliveries per month target, although future figures are likely to show a larger proportion coming from ONVO than from the original NIO lineup. Now, turning back to the stock price during early pre-market hours, NIO shares dipped below $5, which aligns with a confirmed head and shoulders pattern. This bearish signal could indicate further declines, but if the price falls significantly, it may also present a long-term buying opportunity for investors. While short-term delivery fluctuations can be unsettling, NIO overall trajectory remains promising in the broader EV landscape. Despite the challenges, NIO has promising initiatives, such as their upcoming Firefly brand, which could open up new market segments. ONVO production, once at full capacity in January, should contribute to a solid rebound in delivery figures. Although it's tough to watch the stock value drop, especially with Tesla's soaring performance, NIO underlying strategy still points toward growth. For investors with a long-term outlook, further price drops might be viewed as opportunities to strengthen their positions. As always, this is just my perspective, not financial advice. NIO current struggles could mean a lower stock price in the short term, but their core developments suggest that the company is making strategic choices to support sustainable growth over time. Let's see how things unfold, and if NIO actions can build the confidence needed to regain momentum. Thank you for joining us today. If you enjoyed the video, don't forget to hit the like button and subscribe to our channel for more stock predictions and market insights. Remember to turn on the notification bell so you never miss an update. Happy investing, and see you in the next video.